Most people think investing is about picking the right asset. It's not. It's about understanding why different investments exist, what role each one plays, and when using the wrong one can quietly destroy your progress. By the end of this video, you'll understand the main building blocks of investing, why some assets grow money while others protect it, and how to avoid beginner mistakes that cost people years of returns. This isn't financial hype. This is the financial structure. Let's start with the foundation that almost everyone ignores. Here's where beginners usually mess up. They think investing means put money somewhere and hope it goes up. That's not investing, that's guessing. Real investing is intentional money placement. You're deciding what job your money should do, how much risk it should take, and how long it should stay locked in. To understand this, you need one key concept. Pushpin asset classes, explained like a normal human. An asset class is just a category of investments that behave in a similar way. Nothing fancy. No Wall Street secret language. Think of asset classes like tools, not lottery tickets. Each tool has a specific purpose, a different risk level, a different time commitment. Some tools are designed to grow your money. Some are designed to protect it. Some exist to stabilize everything when chaos hits. The mistake beginners make is using the wrong tool for the wrong job. Brain, why this matters more than picking good investments. If you don't understand asset classes, you might put long-term money into short-term tools. You might expect growth from assets designed for safety. You might panic when volatility is completely normal. That's how people end up saying investing doesn't work. No, misusing investments doesn't work. Fork, simple analogy that actually sticks. Imagine your investment portfolio like a meal. You wouldn't eat only sugar and expect to stay healthy. You also wouldn't eat only vegetables and expect fast energy. A good meal needs growth, fuel, stability, balance. Investments work the same way. Different asset classes exist because no single investment can do everything well. Once you understand that, investing stops being overwhelming and starts becoming logical. Warning, brutal truth: most videos won't tell you there is no best investment. There is only the right investment for your goal at the right time, with the right risk tolerance. Copying someone else's strategy without understanding this is how people blow up their portfolios. And we haven't even touched actual assets yet. Now that you understand what investing really is, the next step is the most ignored and most important part of any financial plan. Before you grow money, you must understand where money is supposed to rest safely. Let's clear something up immediately. Cash is not an investment. If you think it is, you're already losing, just slowly and quietly. But here's the twist most people don't understand. Even though cash doesn't grow wealth, you cannot invest properly without it. That sounds contradictory, but it's not. Dollar banknote, what cash is actually for. Cash has one primary job: stability, not growth, not excitement, not beating inflation. Its job is to keep you out of debt, absorb financial shocks, stop you from panic selling investments. Think of cash as the shock absorber in your financial system. When life hits, job issues, medical expenses, emergencies, cash takes the hit so your investments don't have to. Without it, every unexpected expense becomes a crisis. Police car, light, the dangerous myth. Cash is risk-free. People love saying cash is safe. That's only half true. Yes, your balance doesn't jump up and down. You can access it instantly. You won't lose money overnight, but cash has a silent enemy: inflation. Inflation doesn't crash your money. It slowly erodes its buying power. If inflation averages 5% and your savings earn 2–3%, your money is shrinking every year, even though the number looks bigger. That's why people feel poorer even when they save. So no, cash is not risk-free, it's just predictably risky. Chart decreasing. Real example, no math gymnastics. Imagine you keep $10,000 in cash for 10 years. Prices rise, costs increase, your lifestyle gets more expensive. At the end of those 10 years, your $10,000 buys less, not more. That's the trade-off you accept for stability. And that trade-off is sometimes worth it. Brain, when cash makes sense, and when it doesn't, cash is perfect for emergency funds, short-term goals, expenses coming within the next 1–3 years. Cash is terrible for retirement, long-term wealth, beating inflation. If you use cash for long-term goals, you're choosing safety over progress, whether you realize it or not. That choice has consequences. Pushpin, the emergency fund rule. This is non-negotiable. Before you invest a single dollar, you need an emergency fund. Not optional, not negotiable, not "I'll do it later." The general rule: 3–6 months of essential living expenses kept in a high liquidity, low-risk account. Why? Because without this buffer, market drops feel terrifying. You're forced to sell at the worst time. Investing becomes emotional instead of strategic. Most beginner losses don't come from bad investments. They come from bad timing caused by cash shortages. Firecracker, what happens when you skip this step? Let's say you invest everything. Then, Your car breaks down, you lose income temporarily, a surprise bill hits, now you're forced to sell investments during a market dip. That's not bad luck. That's a bad structure. Cash exists to protect your investments from you. Jigsaw, how much cash is too much? This is where people overcorrect. They hear cash is important, so they hoard it. That's also a mistake. Once your emergency fund is covered, extra cash becomes dead weight. Inflation eats it slowly. Opportunity cost grows. Your goal isn't maximum cash. Your goal is enough cash. Enough to feel secure, not enough to stall progress. When people say investing, this is usually what they mean: stocks, buying shares of companies, watching charts go up and down, dreaming about picking the next big winner. Here's the uncomfortable truth most beginners don't want to hear. Stocks are powerful, but they are not beginner-proof. And starting here without understanding risk is how people lose confidence fast. Office building: what a stock actually is. No finance nonsense. When you buy a stock, you're buying ownership. Not a prediction, not a lottery ticket. A real piece of a real business. If the company grows, revenue increases, profits expands, market share, your share becomes more valuable. Some companies also pay you dividends, cash payments for being an owner. So stocks make money in two ways: price growth, income from dividends. That's the upside. Bar chart: why stocks build wealth over time. Historically, stocks have been one of the best tools for long-term wealth creation. Not because they're safe, but because businesses grow with economies over long periods. Innovation compounds productivity, increases, profitable companies expand, that growth flows to shareholders. But here's the catch. Warning: the risk everyone downplays. Individual stocks are unforgiving. You are betting on management decisions, competition, technology shifts, consumer behavior, regulation, and one bad outcome can destroy years of gains. Big names don't mean safe. Popular companies fail. Trends change. The market doesn't care about your confidence. Firecracker: why beginners lose money with stocks. Most beginners buy based on hype, sell based on fear, confuse movement with progress. They see a stock jump 20% and think it's working. They see it drop 10% and think they were wrong. That emotional cycle is deadly. Stocks reward patience, research, time. They punish impulsiveness, overconfidence, short-term thinking. Direct hit: the real role of individual stocks. Here's the part most YouTubers won't say clearly. Individual stocks should be a small part of your portfolio, used after you understand diversification, treated as higher-risk growth tools. They are not a financial foundation, a guaranteed path to freedom, a beginner's safety net. If your entire plan depends on picking winners, you don't have a plan. Brain time, horizon, reality check: stocks demand time. Not months, not weeks, years. Short-term stock movements are noise. Long-term trends are signals. If you can't hold through downturns without panicking, you shouldn't be heavily exposed to individual stocks. That's not a mindset issue, that's a structure issue. Pushpin liquidity: the double-edged sword. Stocks are easy to buy and sell. That sounds good, and it is. But it also makes it easy to panic, sell, overtrade, interfere with compounding. The best performing investors often trade less, not more. Access is not the same as advantage. Jigsaw: so where do stocks actually fit? Stocks are long-term growth engines, volatile by nature, powerful when used correctly, but alone, they're incomplete. Which leads to the next step, the version of stocks that fixes most beginner mistakes. This is the point in the video where investing finally stops feeling like gambling, because index funds solve the biggest problem beginners have with stocks. They remove the need to be right. And that alone changes everything. Package: what an index fund actually is. Plain English, an index fund is a collection of many companies bundled together into one investment. Instead of betting on one CEO, one product, one trend, you own a slice of the entire market. Think of it like this: buying individual stocks is like guessing which single restaurant will succeed. Buying an index fund is like owning part of every restaurant in the city. Some will fail, some will explode in growth. Most will just exist, and collectively they grow. Jigsaw: why this structure is so powerful. Markets don't need every company to succeed. They only need enough winners, enough innovation, enough productivity. Over time, index funds capture that average progress, which historically has been surprisingly strong. That's the secret most people miss. You don't need perfection, you need participation. Chart: increasing long-term reality, no cherry-picking. Over long periods, broad stock markets have grown steadily despite crashes, recessions, wars, political chaos, financial crises. Why? Because economies adapt. Index funds don't depend on predicting the future. They depend on human progress continuing. That's a much safer bet than guessing the next hot stock. Warning: let's kill a dangerous myth. Index funds are safe. No, they are safer, not safe. Markets go down, sometimes sharply, sometimes for years. The difference is you're diversified, you're not tied to one failure, you're aligned with long-term growth. If you panic sell index funds during downturns, you lose the advantage. Time is the price of admission. Counterclockwise arrows button how index funds reduce emotional mistakes index funds. Reduce overtrading, reduce obsession with news, reduce decision, fatigue you're not constantly asking. Should I sell this? Did I choose the wrong company? That simplicity is not boring, it's profitable. Most investors underperform not because markets fail, but because they interfere too much. The real edge. Consistency index funds shine when you invest regularly, ignore short-term noise, let compounding work small. Consistent investments over long periods beat sporadic big bets, emotional reactions, overconfidence. This is why index funds are often the core of smart portfolios. Not exciting, just effective. Pushpin time horizon that actually makes sense. Index funds are built for 5 years minimum, 10 plus years ideally. Short-term volatility doesn't matter if you don't need the money soon. You stay invested. Trying to time index funds defeats the point. This is about ownership, not prediction. Firecracker where people still mess this up even with index funds, beginners make mistakes. Chasing returns, switching funds, constantly selling during downturns. Index funds only work if you let them. They reward discipline, not brilliance. Jigsaw why this is the default answer, even if it sounds boring if someone has limited time, limited experience. Long-term goals. Index funds are not a compromise. They're the optimal solution. You don't need to beat the market to build wealth. You need to avoid losing to yourself. Up to now, we've covered the core engine of investing. But real portfolios don't rely on one behavior. They balance growth, income, and protection, and that's where alternative assets come in. These assets don't exist to replace stocks. They exist to smooth the ride. Used correctly, they reduce stress. Used incorrectly, they blow things up. Office building, real estate without being a landlord. Most people like the idea of real estate. What they don't like, mortgages, tenants, repairs, illiquidity. This is why many investors use real estate-style investments instead of buying physical property. These investments earn income from rent, benefit from property value increases, trade like stocks their main advantage. Cash flow plus diversification. They don't always move in sync with stock markets, which helps stabilize portfolios. But they're still affected by interest rates, economic cycles, property demand. They belong in the middle risk category, not ultra-safe, not reckless. Gold and defensive assets, why they exist. Gold confuses people. They either worship it or dismiss it completely. Both takes are wrong. Gold is not for growth, it's for insurance. It tends to hold value when confidence drops, markets panic, inflation rises. That's why investors keep it in small doses. Not to get rich, to stay stable when everything else gets ugly. Think of gold as financial shock protection, a volatility buffer. If your portfolio feels calmer with a small defensive allocation, it's doing its job. High voltage crypto, high risk, high confusion. Crypto is not a scam and it's not a guaranteed future either. It's speculative. That means huge upside, huge downside, emotional volatility. Crypto is a bet on technology adoption, decentralized systems, future financial infrastructure, but timing matters. And volatility is brutal. This is not a foundation asset. If included at all, it should be small intentional money you can afford to lose. Anyone betting their future on crypto alone is gambling, not investing. Firecracker, the most common mistakes. Read this twice. Here's where people wreck good plans. Too much risk, too early. Right arrow leads to panic and exit. No time horizon, clarity. Right arrow, long-term money use, short-term chasing performance, buying high. Selling low, ignoring cash needs. Right arrow, forced selling at bad times, overcomplication. Right arrow, more assets not equal to better returns. Simple portfolios outperform complex ones when discipline is higher. Brain, how everything fits together, the big picture. A solid investing structure looks like this. Cash, right arrow, stability index funds, right arrow, core growth stocks, right arrow, targeted upside alternatives, right arrow, balance, and income, speculative assets, right arrow, optional, controlled risk, not all at once. Not equally weighted, adjusted to your goals and timeline. This is a system, not a shortcut. Direct hit. Final takeaway. This is the point of the video. Investing isn't about being smart. It's about staying invested, avoiding emotional mistakes, letting time do the heavy lifting. The best portfolio is not the most exciting one. It's the one you can stick with for decades. If you understand that, you're already ahead of most people. So subscribe this channel for more informations.